Hello, ladies and gentlemen, and welcome to our interview with Wesley Sierk. Wesley is the president and lead strategist for Risk Management Advisors, which is a company that provides captive insurance in the United States and actually also probably outside. And Wesley is a recognized expert in the world of asset protection, tax reduction, captive insurance, and executive compensation. In addition to that, he is a best-selling author and a thought leader and currently serves as an advisor to the United States Congress for issues that affect the financial well-being of young entrepreneurs and their businesses. And Wesley, thank you for coming to our interview today.
Oh, thank you for having me.
Absolutely, it's my pleasure. So I believe with your background and expertise, we will have a very thoughtful conversation about asset protection, tax environment, and risk management, and especially about your main business, captive insurance. Wesley, can you tell us a short story about your unique path in the industry and how did you get to where you are now?
Yeah, so I started in the industry as selling insurance. And then around 2000, I realized the insurance companies always had more money than I did. It didn't matter how much commissions they paid me. They always had more. So I said, I want some of the insurance company money. So my partner, Jared, and I set out on a path to figure out how to become an insurance company. And then from there, once we started our own insurance company, that's when we said, you know what, let's just take the skills that we learned from creating our own insurance company and take that out and set up and manage insurance companies for other people, other business owners.
Mm-hmm. So let's take a closer look at what specific your niche is, captive insurance. Why companies use it, and what advantages come in with this type of insurance?
Yeah, so a lot of our clients, they pay for insurance premiums year after year, and they do a good job of managing their risk, but they never really see the benefit of all their risk management in cost savings. So they turn around and they say, you know what, let's become our own insurance company. So we set up a captive, and then they can pay premiums from their business to their own insurance company. And because they do a good job of risk management, they get to keep the underwriting profit that normally would have gone to insurance companies. And because of the global reinsurance community, they have access, captives have access to global reinsurance, so they can really dial in exactly how much risk they want to take for different lines of coverage.
Mm-hmm. Is it only popular in the United States or in other countries as well?
I mean, the United States is popular, but if you look at it, some of the largest insurance companies, most of the largest insurance companies and reinsurers in the world are outside the United States. But it's large global companies create their own insurance companies. And then you have jurisdictions all over the world: Bermuda, Bahama, Cayman Islands, Isle of Man, Guernsey, Singapore, Hong Kong. I mean, all of these are very large jurisdictions for captive insurance companies. So companies in Europe create their own insurance company, so then they can insure their own risk. Companies in Asia and India and the United States, it's a global industry. And the last released information that we have right now is 2018, but it's estimated that 50% of the insurance in the world is in an alternative structure in one way, whether it's high deductible, retro policies, captives. So many companies are taking the risk.
Mm-hmm. So what is the typical structure of this company? Is it, and probably on what criteria and type of businesses this type of insurance will fit the most?
Yeah, great question, Boris. We have many different industries. But typically it's a larger business that's paying a significant amount of premium, and the cost for reinsurance is lower than the cost that they're paying right now for their insurance. So let's use a rough number of whatever your premiums are. If you can get reinsurance for 30 to 35% of your traditional premiums. So if it's €1,000,000 for your premiums, if your claims are low and going out to get reinsurance is in the 300 to 333, or maybe even as high as €400 for the reinsurance, then it could make, it could be attractive to you. And then let's say you had €200 in claims. Well, now that if you paid, let's even say 400, you paid 400 for your reinsurance, you paid 200 in claims, that 400,000 euro that you would have given to the insurance company as far for underwriting profit is now yours to keep inside your entity.
Interesting, because probably now in the pandemic time, I'm interested. What is the influence of the pandemic on this field of captive insurance? Probably there have been a lot of claims, and premiums also went up. So can you elaborate on this?
Yeah, I mean, the pandemic has been devastating for many businesses. But the good thing is, so our business interruption policies that our clients have been writing inside their own insurance company have covered viral and bacterial events since 2015 and 16 with MERS and SARS. And so far, I mean, I don't have the exact amount, but so far the captives that we've had have paid out over $50 million to the business owners from their own captive back to their business for business interruption. And some clients, it's been a godsend because they didn't have money, and their captive insurance company has, millions in reserves, and they had the ability to, we went to the insurance commissioner and said they want to take a loan from their captive or a dividend from their captive back to themselves, and that gave them the money to keep their business going. So that's people getting paid out from the pandemic. But we also have a fair amount of people now, business is brisk because insurance premiums have shot up. And they're now looking around saying, I was paying 400,000 last year, and now I'm paying, my renewal quotes are in the 650 range. Is there a better solution? So business is good right now because there's so many people who are getting large increases in their premiums that now are looking for other alternatives. And it's interesting, you're in the risk management field, so you're aware of this, and probably many of your listeners are, but the insurance industry, the insurance companies have seen their excess capital and surplus decimated because they've had to give premiums back, they've had claims, but they've been buying less and less reinsurance, in the soft market. So when premiums, insurance companies make their money from premiums, investment return, and they pay out claims and they buy reinsurance. So if they have to pay out dividends to shareholders and their premiums are going down, and then you look at investment yields globally for secure either government or corporate bonds have been going down, those yields have been going down as well. So they have less money coming in premiums and less money from investment returns, but they have to give out this dividend. So what happens is they've been buying less and less reinsurance throughout the years. And I mean, this is like a macro cycle. And what happened is the insurance companies were hit very hard, but the reinsurance market hasn't been hit nearly as hard. So there's still the opportunity as the premiums go up for business owners to buy reinsurance, and the reinsurance premiums haven't moved the way traditional insurance has moved. So it's been I haven't really seen this since 2006 or 7. as far as this weird anomaly in the insurance and reinsurance market.
Mhm. Mhm. So what are the people probably interested, what are main benefits in tax reduction for the owners, and what are your, what do you have as a tips do you have for how to protect wealth and in this today's economy?
Well, the interesting thing is insurance companies are given special benefits that other companies aren't. The taxation of insurance companies is different than other businesses. So you have your business, Boris, it takes in money, you make your raw, you turn your raw materials into whatever widgets you are, you then sell your widgets and take back the whatever's left over, income minus expenses, that's what you pay taxes on. Insurance companies aren't taxed that way. Because if you think about insurance, insurance companies take in premium dollars, but at the end of the year, let's use, general liability or comp or auto, you could have claims that get paid out over years and years and years. So what happens is if insurance companies took in premiums and they had to pay taxes on everything that wasn't paid out in claims, they would never have enough money in reserves to pay claims when they come. So insurance companies get deductions for the money that they put into the reserves of the company. So a business owner that creates their own insurance company, they get the same tax benefits. Premium dollars come in, but they put that money in reserves. And then when they put the money in reserves, then it's not taxed as underwriting profit to the insurance company. So right now, business owners are saying, okay, we're going to come in and instead of paying this increased premium to the Liberties, Zurichs, Transamericas, and you name it of the world, we'd rather create Boris Insurance and pay our premiums to Boris Insurance and then go and get reinsurance to cover our catastrophic risk. And build up this war chest year after year after year, like our clients did. And then when the pandemic hit, they had the money there to pay the claims or take dividends. So right now, it's a perfect time. Interesting. I always say insurance companies are the most creative people in the world. I just came across because right now in the United States, they're debating this tax bill, the infrastructure bill. It could be up to $5 trillion of spending, and it'll be increasing it's increasing income taxes. It's could increase capital gains tax. So I just came across a Lloyd's of London policy that's a capital gain increase insurance policy. So somebody can buy a policy from Lloyd's of London because right now the capital gains is at 20%. So if it goes to 25, they cover that shortfall. If it goes to 27, if it goes to 35, you basically can buy your projection or your prediction on what capital gains could go to and protect that, extra tax you'd have to pay. And I'm like, wow, it didn't take them more than a month to come up with that policy once it looked like taxes. But if so people are buying that policy. So if you think about, Lloyd's, people are buying that policy. But if Congress and Senate can't get the votes to pass that, because right now they need everyone going down this line. If it doesn't pass, then Lloyd's just made a ton of money because capital gains taxes didn't move. But so I was talking to a client yesterday about that insurance, and they said, well, I don't think it's going to pass. And this is really expensive insurance because he has a net worth of, I don't know, let's call it 100 million. So that could be meaningful to him. So we priced out the policy. And he said, well, I don't think it's going to move. So why don't I just insure that risk in my own captive? I'll charge less premium than Lloyd's was doing. And so now we're having the actuary price out, does it make sense to to buy that policy in their own captive.
Oh,
So now those premium dollars would go to their own insurance company, deducted from the business. And then if it doesn't pass, now that's just more money in their
Expense.
insurance company to
Oh.
offset any risk that could come down the road for other things.
no. Interesting. So yeah, there's a speculation that capital gains tax will double even. Yeah. So and I wonder, you serve also as an advisor to the United States Congress for issues that affect the financial well-being of young people and entrepreneurs in their business. Can you tell us more about this interesting stuff?
Yeah. And in one hand, it's exciting, and in one hand, it's depressing.
Oh.
I'll tell you. The Financial Services Committee is made up of, I believe the number's always changing, depends on who comes in, but let's call it 64 to 66 people, representatives. And they're all really good, well-intentioned people. But, you know, at last count, only 3 of them had owned their own businesses.
Oh, yeah.
So they'd never signed, many of them, and it's a problem, and this isn't political, but it's a problem with Biden. He never signed the front of a check, only the back of a check. And that's the thing is, I remember, so if you look at the stock market goes up and down based on quarterly earnings projections. So I was there the day that these elected officials were sitting around talking and discussing the quarterly fluctuations based on the earnings reports. So they all, and it's kind of groupthink, they all said, well, what if we go to monthly electronic reporting? We could smooth out all of the ups and downs of the market. But that it takes somebody who doesn't understand what it takes to file these quarterly financial statement or quarterly projections for your publicly traded company. So they all thought it was a great idea, and they said, what do you think? And around the room, because these are people who actually have publicly traded companies, they're like, you'd ruin capitalism. I take my company private, you know, I'll buy back all my stock. I mean, it's just, and they were all shocked, like, whoa, you know, they all thought that they had the best idea in the world. And then, but they don't even put it by anybody else. And they were blown away that everyone didn't think it was the greatest idea in the world. But it's shocking, just the disconnect, and the people who are setting the financial road for the country. Because remember, the IRS doesn't make tax law. Congress passes tax law, and then the IRS enforces it. So you have a bunch of people who haven't run businesses and really don't understand how economies work in order to, you know, setting the direction for the country. And it's, you know, that's where I'm saying it's interesting, but at the same time, it also is depressing when you realize that, you know, what could come to pass because they don't really understand what they're doing.
Mm-hmm. Interesting. So I want to hear your personal opinion. What is the commonly held belief or misconception in the field of your expertise with captive insurance that you are strongly disagree with?
I would say that this is only for the largest of large companies. So I would say the 1,000 largest companies in the world all have their own insurance companies. So there's this commonly held belief that I have to be huge in order to do it. But I will tell you, many of our companies are middle market companies. Mm-hmm. You know, they have 100 employees. Mm-hmm. They're doing $10 million in revenue. Mm-hmm. But it doesn't really have to do with the size of your business. It has to do with the amount of risk that you have in your business. And right now is a great time because, as I said, reinsurance prices are low. So I think anybody, you know, I would say if you're paying $1 million or €1 million or more, you should probably look at it. It may not be right for you because we run into people all the time who they're like, oh, my insurance is crazy. And I'm like, all right, let's look at it. and they're paying $1.2 million for a policy, and their claims were $3.4 million last year, and then 2.7 the year before. And I'm like, I'm surprised the insurance company even renewed the policy, because you should take that policy and run. It's not too expensive. But I mean, they should, if you're paying that $1 million, you should at least look at it. It's not saying that it's right for you, but at least review it for yourself.
Mm-hmm. So, for example, if somebody who is in the position of some companies about 10 million or maybe $1 million in insurance premium would like to take some steps, what will be kind of first 2 steps to take on this path?
The good thing about this is data. What we need is data. So it's not limited to just what did you do last year or the year before. Let's look at the insurance spend over a 10-year period of time. Let's look at the claims over a 10-year period of time. Let's look at the growth of your revenue over a 10-year period of time. The employee count. I mean, there's a lot of stuff that goes into it, but then the actuaries, our actuaries, they basically take all that data and they put it in, and then we know what filed rates, and of course there's negotiations around that, but filed rates around what reinsurers are going to charge. So once we have the data, then it's just an analysis. It's never emotional. I tell people all the time, this isn't an emotional decision, it's dollars and cents. And if it makes sense, great. They still do or don't do it, but it becomes very clear what they would benefit from it. Or like I said, that example of someone paying $1.2 million and their claims are 3.4. I mean, it becomes very clear this is something you should run from. But it's gathering the data, getting it to somebody, not just our company, but there's great companies all over the world that do this, and have them analyze it for you to see whether or not it makes sense for you.
Mm-hmm. Okay, so what do you think your industry as a whole is? Where do you think it's heading, and what are the trends in the space, and what we should perhaps expect from you guys in the future?
Well, the great thing about our industry is it's very innovative. So there's always people that are coming up with new policies, coming up with new things. I would say if you look at our industry right now, business interruption is huge. Companies that suffered during the pandemic, they paid for business interruption insurance and they haven't been paid anything from it. So they're looking to say, okay, now that we're back in business and we're making money, can we protect against this going forward? Cannabis, I don't know how large it is in Europe, but cannabis is becoming bigger in the US, of course, but also South America. You have the Far East. I mean, there's a lot of places, and cannabis, there's very few insurance companies in those, and it's kind of a shifting road. But that's an area that we're doing a lot of work in. So the captive industry is, to me, really poised for growth. I know our business last year during the pandemic, and it's kind of like you have survivor's guilt, because last year, a lot of businesses suffered, but last year was our best year ever as far as captive formations, because insurance started going up and people needed this insurance. And this year is already better than last year. So the amount of people that are looking for captives as an alternative, it's ever increasing.
Mm-hmm. Fantastic. So I ask this question all my guests because I'm running a global risk communities, a platform for risk managers over the world, and we have about 100,000 on our platform and on different groups and on podcasts. And I would like to ask your opinion. How can we contribute to the process of a better understanding of this complex world of risk?
I mean, by staying involved and listening to your podcasts, I was listening to one a few weeks ago where you had a gentleman that was, and his name escapes me, but he was talking about they'd set up the artificial intelligence and data mining of their own company. And as a result, they are, their claims experience is far better than their peer group. And as a result, they use that to go back to the traditional market to negotiate much better terms. I mean, they were able, because of data, to get big savings in the traditional market. And it's things like that. People that are actively doing the risk management, like your podcast says, and all the different solutions. You implement that, but it's taking that one step further, in that then you form your own insurance company, and the same way you negotiate lower fees, lower premiums with the traditional market, you can get that same data, go and negotiate with reinsurance marketplaces. And now you're making a lot of that underwriting profit. So just
by listening
by staying involved in that, I mean, you have such good information on your podcast and in your global risk community that, people, by staying involved in it, understanding the trends that are coming out, understanding the court cases that are coming out, suddenly an insurance company loses. And then, I mean, before you know it, that whatever the insurance company lost on suddenly becomes an exclusion in the next policy cycle that gets released. So it's not, it's not just setting it and forgetting it. It's continually looking every single year at all your policies and all your exclusions. And then it's not uncommon to negotiate those exclusions away. So just because it affected one and they just add that to all their policies going forward, look at every exclusion and say, no, we're not accepting this. We're not accepting this. And I'd say most times insurance companies will cave because they want the premium dollars, and they know, at the end of the day, they're going to be making the profit on it.
Fantastic. Thank you. That was all my questions. Perhaps if I forgot something that you want to add that will benefit our audience.
Yeah, I don't know what else. I mean, captives are phenomenal, but captives are phenomenal for companies that have already taken the step to manage their risk, to follow the stuff that you have in your global risk community, all the different suggestions. So then you become this machine that works very efficiently. And then that's when you take that machine out of the traditional market and become your own insurance company. So my hat's off to what you do and your all the content and being a thought leader in the industry.
All right. Thank you very much, Wesley. It was my great pleasure. And I wish you success in your future plans, and hope to hear from you maybe in a few months about new developments in your field.
Yeah, I'll keep you up to date with anything I find. And
all right.
Thanks for what you do.
Thank you.